Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to a brand new edition of the State of Economy podcast. I'm Hamsini Karthik, and today we're here to talk about matters of finance. Joining me is a veteran in the banking sector, more so in the retail space,
Rajan Pental,
Executive Director, Yes Bank. The Reserve Bank of India last week came up with new risk weight assets norm, basically targeting the unsecured portfolio. It said risk weights on consumer durable loans, on unsecured personal loans, credit cards, all should increase. It was about 25 bips of increase across the board. Likewise, loans to NBFCs catering to these sectors would also see higher risk weights. Well, what would all this really imply to the lending arena? Will banks see lower growth? Will banks be able to price their loans accordingly? Because at the end of the day, if capital is going to increase, the cost of capital will also increase, and they will have to ultimately pass it on to us, the borrowers. But was there enough demand for us to absorb higher costs? Mr. Pental is here to break it all down for us. Thank you so much for joining us on this podcast, sir. Was it a bit of a surprise when the RBI came out with the norms last week on higher risk weights for certain categories of unsecured loans, and a little more surprise when you had to extend it to non-banks as well?
So, first of all, it's my pleasure to be interacting and be with you on the call. No, I think the regulator has given sufficient time to the industry. In fact, if you look back in the last 1 year, the regulator has been on various occasions indicating much in advance, whether it is pertaining to governance, whether it is pertaining to the risk weight revision, what they are looking at, whether it is also in terms of any kind of a risk viewing in certain sectors of the retail. So I think there has been enough and more caution in the air. And I don't think anybody would be really surprised. At least I was not surprised at all. And the inclusion of NBFC also, in our various actions, RBI has been, the regulator has been actually, indicating to a fact that there are certain clienteles which have to be kept, outside the periphery of your acquisition. And this has been a message to the banking industry. And the caution has been that if you are not directly acquiring these customers and somebody else is acquiring and you are then taking over that customer, it tantamounts to the same scenario wherein you are acquiring that customer. So I think this is a sensible thinking, and this is a sensible practice which will keep, in the good times, which will keep the portfolios intact for the banks.
We have a lot of estimations around what could be the impact on the capital adequacy as such. I don't want to get in there. But one of the things that bankers have often told us from last week to now is that we will accordingly price the loans. But what I would like to understand from you, sir, is that whether there's enough pricing cushion right now available in terms of demand that you can appropriately price for these higher risk weights. Do you believe that there will still be demand buoyant in the market to absorb the kind of pricing or elevated pricing that you might want to pass on to your customers post RWA increases?
So, first of all, the banks are adequately capitalized, right? So I don't think there is any issue on the capital adequacy, etc. So that is not the concern at all, right? And if you look at from an overall portfolio, the return on capital anyway is actually taken care of. So that is not a problem. But there are certain products, to keep them prudent from a portfolio construct, right? With the elevated risk weights, you have to to get the right return. On those products, you will have to do some adjustments. But at the same time, I think another parameter also needs to be think through is that how much should be that interest which you can pass on, and what will be the impact of that elevated pricing on the demand, right? I think everybody will be very cognizant of that and do the right balancing. If you look at in the last couple of months, there has been a journal underwriting tightening which has been undertaken by the banks. So anyway, certain profiles have taken a beating. The bank norms have become more tighter, and that is across the industry, whether it is banks or the NBFCs. And now the pricing. So I think market will be cognizant of the fact that how much cushion is available, not only from a perspective of the return on those products, but also from a consumption perspective. So it's a very calibrated, thought through process, which will undergo into any kind of a decisioning around it.
Perfect. The other side to it right now is that we're not seeing, while delinquencies are increasing, it's not so alarming yet, is also because some of the high growth that has happened is also through digital lending. And digital lenders are very nicely playing on the affordability part, in the sense that it's not EMI that's getting charged, it is EDI, which they're able to sort of break down basis the income propensity of the person and so on. With this sort of a recovery mechanism or a repayment mechanism that is being followed, do you believe that there is, it can continue, this sort of a mechanism can continue even after risk weights are tweaked higher, because accordingly pricing will also move up? So how much can the borrower really absorb? That is my question in short.
No, it's a very valid question. So let's divide this question into two parts. First of all, the risk tightening, what I spoke about, is generally on certain segments or certain markets or certain profiles, right? Which actually is a ongoing part when you are building retail portfolios, right? So as an ongoing process, you keep on looking at what segments are doing better. There you kind of loosen up a little bit. You create straight through processes, and on certain segments where you think the stress might brew, not necessarily is brewing, they undergo a regular cut. That is how you run your retail portfolios.
Okay.
I think last couple of months, what actually has been observed is that the new to credit people have the banks and the NBFCs have started taking a closer look, and they are looking at more minutely, more intensely. So while certain segments will still continue to flow through in the straight through process, but certain segments will undergo scrutiny, because in every segment there are good and bad customers. And I think the prudent underwriting practices, when you are able to weed out the poor profiles. Now, coming on to the structured financing, what you just spoke about, wherein there are bullet payments, there are repayments, aligned to the customer income flows coming in and stuff like that. I think, for every segment, there has to be a prudent pricing decision. So you have to balance the pricing with the risk associated. I don't see discontinuation of any kind of a scheme, but per se the pricing will accordingly move up or down, right? So the product alteration will not that much have any impact. But given that now your RWAs are revised, so the pricing prudence will actually be there more in the system, right? So there will be pricing for the risk, what you take. There will be pricing for the variants which you want to put through as a convenience product to certain set of customers. Certain set of customers might be eliminated, while certain set of customers might move to even the straight through process, right? Okay. So as long as you have adequate pricing to cover your risk, what you are taking, I don't see much of an issue or much of an alteration there.
Perfect, sir. The last point. At FIBAC, the larger opinion that came out is that now growth will become a little more sensible the layer of exuberance that we saw in some of the lenders, including a few banks, may somewhere start rationalizing. You concur to the view?
See, last couple of years, if you see, has been a fabulous era, a memorable era of cleaning up of the banking system, right? And today, where the banks stand, or the NBFCs stand, is one of the best period in their life cycle, right? Now, during the best of the life cycle, what practices you have to follow, right? Particularly at a time when your cost of technology is going up, your cost of compliance has gone up. What exactly you need to do? And it is not about always pricing, first of all, right? It's a wrong call that any increase in cost, any increase in cost of capital, or any other direct or indirect cost within the institution should result into customer pricing. I think this is a misnomer, right? A lot of cost still will get released from the efficiencies being created. I mean, let's look at it. Supposing you are creating a platform for which you have to actually invest a lot of money. So in 1 year, it will look at an investment going into creating the infrastructure. But in the subsequent years, you also get the benefit of the efficiency or the capacity created out of it, right? But I think one thing which comes very clear, and the industry also has been moving from corporate to retail, and then SMEs, the new flavor. So and all of these pockets have their own set of challenges also, and great opportunities also. One learning clearly is that nobody is going to falter on the risk associated with a particular client profile, and then adequately pricing it. Now, if it means that certain set of clients will be included and certain set will be excluded, that is a different part, right? Now, there are whole lot of customers who are coming into the organized economy, right? The smaller part of the unorganized part of SME is very fast moving into the organized part of SME. So there is a whole lot of flow which is happening, which is coming into the formal economy or into the formal underwriting practices, right? They are also going to fuel the demand a lot. So while you will have your prudent practices to underwrite, you also have new segments which are coming in. But clearly, one caution is there that when you are building portfolios, you have to be cognizant of the fact that you do not dilute the quality of the portfolio. So certain segments will definitely get excluded, even if it means a very short-term, cut in the business. That's fair, because ultimately that will lead to rather increased business, right? So the temporary 10%, 15%, 20% going here and there in terms of growth is then going to be augmented by the new clients who are also entering into the segment. So I don't see when India is moving towards 5 trillion, and today why talk of 5 trillion? We all have started talking about 25 trillion. Infrastructure growing, job opportunities increasing, sectors doing well. I think our economy is doing so well. So there is enough and more opportunity for the banks and NBFCs to lend to the kind of quality customers they set their eye on. So I don't see, except some temporary disruption here and there, even medium term or long term, there is going to be any impact.
That was all you had to know about the risk-weighted assets. We'll come back to you very soon with another interesting topic on the State of Economy podcast. Till then, take care and bye. This is your host, Hamsini Karthik, signing off.